is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I am Alex Tapscott. Business author and Professor Clay Christensen once said that markets that do not exist cannot be analyzed. Not only is the market opportunity unknown when a new technology is created, it's unknowable. And Christensen has talked and written a lot about different technologies throughout history. The rise of the computer. Computers originally were data processing machines used by programmers, but the PC turned them into consumer devices and business devices that everybody used. At the time that the PC was created, the market opportunity for that new technology was unknown and frankly unknowable, because the paradigm that we had to that point in time was that computers were mostly mainframes operated by trained professionals and programmers. And today we're experiencing several different technology revolutions at the same time in AI, in relation to crypto, and robotics, and so forth. And I think the same kind of stance that the technology implementation and expectations are unknowable is something we should keep in mind. And I think that there's one really interesting example of this in crypto, and that's tokenization. So when it comes to tokens, as we've said before on the show, myths and misinformation abound. Often all tokens are classified as crypto, as in cryptocurrencies. And in our view, this is kind of unfortunate, as the term cryptocurrency is a bit of a misnomer. The fact is that many, if not most, tokens are not trying to be currencies in the traditional sense of being a medium of exchange, unit of account, or store of value, but rather you can think of them as containers for value, digital containers that can be programmed to represent everything from financial assets like stocks and bonds, to titles and deeds, to claims on commodities like gold, and so forth. But to channel Christensen, the market opportunity is unknown and unknowable. So beyond what we think of tokens representing assets, they could come to represent so much more than that. So there's a big potential that the world's assets and how we move and store value will happen digitally on open public networks, peer-to-peer between people all around the world. But to get there, there are many different implementation challenges. There are technology challenges with the underlying platforms. There are uncertainties and concerns around regulations and how these technologies will be rolled out. And then there's the business question. There are vested interests that will fight against change. There are powerful intermediaries that have markets to protect. And so the expectation is that while the technology is ready for prime time, there are still many hills to overcome. Now, things have happened in the last year which give us a lot of confidence. I'm fond of saying that there's nothing so powerful as an idea whose time has come again. And in the last couple of episodes, or last few months, I should say, we've talked to a couple entrepreneurs who are building out technologies to accelerate this tokenization revolution. And I'm very happy today to welcome another guest who can help us to understand this opportunity at a much deeper level. And that's Vincent Kadar, who's the CEO of Polymath. Vincent is a seasoned leader who's driving the growth at Polymath, where he oversees the development of an innovative software platform designed to transform capital markets for the next generation. He has 25 years of experience across various areas, including scaling startups and leading technology-driven companies, and comes to the firm where he has been in a senior leadership role for many years with this wealth of experience. Polymath, for people who have been in the blockchain and crypto world, will sound familiar, and maybe even it's something that you've used before. Polymath is a fintech company transforming the private securities market with its white label SaaS platform for tokenizing real-world assets. Polymath provides a scalable, highly customizable solution that goes beyond traditional all-in-one platforms, allowing issuers to design a compliant and efficient issuance process tailored to asset type, jurisdiction, and goals. Vince, welcome to the show.
Thank you, Alex, and pleasure to be here.
All right, let's jump right into it. So I kind of went over your background a little bit, but you've got this like varied and very interesting experience in the technology world. How is it that you ended up in the crypto space?
It's interesting. I have, I've always been in startups. Well, actually, that's not true. Started off in a big consulting company, but then immediately went to startups after about 3 years working in it, Accenture. And startups are A, fast moving, B, actually very interesting, and C, disruptive, right? And the disruption is what interests, I think, any entrepreneur that's out there or anybody that's trying to build anything, or it's what attracts a like-minded group of individuals to, to build something, and to build something of value. In my last startup, which was in digital payments, and that was, again, we're transforming fiat payments, to digital payments, integrating and developing. I'd call them like first banks in a lot of developing markets as well. So like we were leveraging what we called a sector called mobile money, which was developed out of Kenya by Vodafone, and the brand name was called M-Pesa. We were the challenger platform in all of Africa, and that was pre-Bitcoin, pre-blockchain. That we built a highly transactional platform, in order to disrupt the payments industry. But, again, what we saw along the way was that, Bitcoin came on the scene and blockchain came on the scene, and we were highly worried that, this is going to eat our lunch, because we were in payments, and Bitcoin was originally, defined for payments. But, long story short, that didn't happen. It didn't materialize. But along the way, we were working with the Gates Foundation on a project to intertwine all of the individual platforms and the payment platforms that we had throughout Africa, the Middle East, and Southeast Asia, and Latin America, to build what was called a level one platform, and to level the playing field of the industry, to ensure that when payments are transacting across international borders, that the likes of the Western Unions and the MoneyGrams weren't keeping the lion's share of the revenue or of the funds that are being transmitted, but it was being transmitted to the people that needed it.
Right.
And so along came Ripple. In that time frame, Ripple was brought into a project that we were doing with the Gates Foundation. They were our interledger protocol. That was back in 2016, 2017 timeframe, right?
Yeah.
We bumped into Ripple, I think, back in 2014 to 15, actually, earlier on. But it was hey, this is interesting, right? Crypto is powering actually this new paradigm in this new world. And, that gave us exposure into, the likes of crypto, on how crypto, at least from a payment point of view, is really going to help facilitate swift payments in real time, atomic transactions, right? And to really cut down the cost of the intermediaries that weren't adding all that much value.
Yeah.
So anyway, long story short, sold that business to Constellation Software, but then found a nice entry point where, well, I wanted another tough problem to solve, right? And didn't know anything really about capital markets, but I did know as much that it really hasn't been disrupted, right? And again, that's what attracts actually anybody to an industry, to say, well, there's a tough problem here, because it's an industry that's been, and I think you alluded to this earlier on, where there's a lot of mouths to feed. There's a lot of intermediaries. There's a lot of push actually from different parties, depending on like the industry that you're in. We saw this with Uber as well. We saw this, with Napster in the early days also. For those that have been tracking, different vertical markets and, and sectors. And we're seeing this now in capital markets and how they're operating, and how they're, how the players, the multiple layers of players actually in this industry. Yeah. What attracted me to Polymath was exactly that. New technology, hard problem to solve, a lot of people pushing against it. So, the one that's going to, crack the nut as far as delivering a viable and valuable solution here, they're the ones that are actually going to, really add the tremendous value, right? And tremendous value from the overall ecosystem per se. But, also comes with, with all this tension is a large reward, right? And a reward for the industry players that are aligned with, Polymath in general, right? And so it's an ecosystem that's going to help push this industry forward. It's not just one company and one individual.
So interesting. Your experience in Africa is familiar to me and to a lot of people who I think started in the crypto space way back. So, and you went into it in some detail, but the opportunity, like with the company that you created with M-Pesa, was basically to bank parts of the population that were unbanked. It wasn't like people went from going into a branch to using mobile money. It was they were using cash and transporting it manually between the city where they may have worked into their families living in the countryside, and replaced it basically leapfrogged legacy infrastructure and went directly into the mobile world. And what was so remarkable to me about those initiatives, and I'm glad that we're digging into this, is that they happened in a pre-smartphone era. People were basically using mobile money on regular smartphones, or excuse me, regular cell phones. Now, the thing about these systems, though, is that they were closed loop, like they were controlled by companies, and those companies became too big to fail in those countries. We talk about banks controlling 10 or 20% of customer deposits. I think at one point Vodafone was handling 80% of all retail transaction flow in Kenya. And at the time, I remember meeting a woman, Elizabeth Rosiello, who had created a thing called BitPesa, and it was basically trying to build M-Pesa on the Bitcoin blockchain. But the Bitcoin blockchain at the time, and I think really to this day, is still not quite ready for prime time when it comes to small dollar transactions or ease of use. But what's interesting is that we actually have seen something come along that has disrupted the Western Union, MoneyGram, correspondent bank / mobile money, telecom controlled payment systems, and those are stable coins. Now, stable coins are not widely used by everybody in places like Kenya or South Africa, but they are increasingly popular. I think more than half of all crypto volumes, for example, in sub-Saharan Africa are in stable coins. I was in Brazil recently, and the central bank is concerned about the massive increase in stablecoin volumes, not just between people in Brazil and their families living abroad, but people substituting stable coins for the local currency as a way to store value, which I think is really interesting. So, money is this sort of first killer use case for tokenization, where the first thing that got clear product market fit was tokenizing US dollars. But once people have access to a US dollar bank account, the next thing they want is a US dollar savings account or investment account or access to US dollar denominated financial services. And that's where I think there's this really interesting segue into Polymath and what we're talking about. Because right now, if you look at the total value of all tokenized assets in the world, I think over 90%, if not 95%, are USDT, USDC, and some of these other US dollar stablecoins. But there's this small and growing category of other assets. Now, I'd love to understand this a little bit better, because when it comes to payment tools, these things have been able to grow not in spite of or because of regulations, but they've been able to grow organically. But I feel like the world of securities tokens, for example, are running into much more stringent rules and regulations. And I'm just wondering, as you think about the growth of tokenization, especially for those populations in places like Africa, where you had built a business that helped to move the financial infrastructure forward, how you think about this next stage. So the next stage being we figured out tokenized dollars. Now, how do we figure out other tokenized assets?
Yeah, no, that's a good question. So, my attraction for at Polymath and why this was interesting to me, because and it's leveraging the work that I did in these developing markets, right? Because once you actually introduce a basic payment system or a banking system, which is what we set up, right? The next, you go from let's call it a checking account, then to a savings account. Well, what's the next step after a savings account? An investment,
Yes,
right?
exactly.
Right.
Yeah.
And so that's the trajectory. And my thought process behind this was that once we have the regulatory framework sorted out, well, it's easy enough to then go back to those payment platforms and those initial banking platforms that I had and say, well, I've got your investing platform now, right? And this is how it's going to orchestrate. This is how it interconnects to the rails of the existing digital payment platforms that I installed in that, I'll call it that first generation, or that first wave of digitizing money, right? Because we digitized money, and now, now we're on to even something a little bit more attractive, which is the stable coins actually that are out there as well.
Mm-hmm.
So when it comes to securities and digital securities, that is, the security tokens, those are very interesting from a regulatory point of view. Like, we have Polymath is not just a North American play; it's a global play. We've
Yes.
been in discussions and interactions with like regulators from all around the world, and some of my old stomping ground as well, as far as where I used to spend a lot of time. As far as what can be done and what can't be done. My view is that, and very much similar to what you highlighted, Alex, is that the developing world is going to leapfrog again, right? And they're going to
Yeah.
leapfrog into, well, we have an exchange, right? Doesn't really work, or there's something that's here, but the regulatory framework can be adapted in such a way that it will operate on a 24/7, blockchain that provides, the clarity, the transparency, and the assets actually that would be tokenized, actually, the digital assets that are tokenized, actually, the underlying structures, right? So we've spoken to, even in Kenya, like the Department of Housing, that wants to tokenize housing, because housing is expensive in Kenya, like it is
Yeah.
in other parts of the world. Well, how do I give access to, as an investment product, to people that will invest now in their backyard where they live and breathe, that they can now own a product, right? And they can feel proud of, I've invested in the condominium corporation that that I'm living in, or the apartment dwelling, and that's also connected to the local grocery store. So it further cements my spending patterns and my habits to the area and the community that I've invested in.
It's interesting because, like, a lot of the tokenization of RWAs and securities have happened in the developed world, for lack of a better word, right? So, BlackRock's Biddle and the other treasury funds are now in the billions of dollars. KKR, Apollo, and some of these other financial services firms, Fidelity, are doing some important, I would still say experiments, but important work in this space. But actually, it's a classic example of what you just described, which is that the need for a way to own, trade, custody assets to build wealth is much greater in places where it's very underdeveloped than where it's already well developed. Like, if I want to get exposure to investments, I can open a discount brokerage account, right? Like Robinhood or something, like anybody else in the world, with as little as a few dollars. And I will have access to a pretty wide range of investments. I mean, all the world's stocks and bonds, or most of them in North America, but ETFs and so forth. But if you're living in a part of the world where you don't have access to, a bank account, where you don't have access to investment accounts, which is actually where most people live, being able to invest in anything that can compound and store value is like a superpower, right? And the discussion about housing, I actually think, is really interesting. When I wrote Blockchain Revolution with my dad, we interviewed a very famous Peruvian economist named Hernando de Soto. And Hernando de Soto, his whole thesis was basically that, like, the foundation of wealth creation and of economic stability is land titles. So he made the case that 70% of the world's population who thinks that they own land, or thinks that they own an asset or a home, actually has an unenforceable claim. There could be another title that's owned by someone else to the same land. There could be missing records. There could be a duplicate. It could be a forgery. There's no actual way of proving this. The way that we do things here in Canada or in the United States is, you've got registrars and governments that maintain these records. And then you buy, title insurance to ensure that, in the event that there is a dispute, you're covered. And we have this whole system of doing it. But in most parts of the world, that kind of system doesn't exist. So to your point about tokenizing assets, like housing, it's not only that, you create ways for people to invest in that kind of asset class, but what you're doing by enshrining it on these public, open ledgers that everyone can see and access and trust, you have an enforceable way to prove title. And that is a way to actually help those people in those parts of the world build wealth and create wealth in the long term, right? But the practical side of it is that there's a zillion implementation challenges to making that happen. And I'd love to understand that part of it a bit better, not just in Kenya, but in general. Like, what are some of the challenges that you face as a business? You've got this concept, this technology that inherently seems to be paving the way towards the digitization of assets, but it's never that simple, right, Vince? So tell us a little bit about that.
Yeah, like I think some of the apprehension what we see in the industry, and I saw this as well, like when we were approached by several asset owners that wanted to issue security tokens.
Yeah.
The first question that that we ask is that, do you own the asset? And how do I know that you own the asset, right? And that's the biggest problem. And even when you touched upon like land title, those are land transfer. The registrar that holds title in Canada or Ontario, again, that's not running on an immutable blockchain, and it should be, because if it was, well, you wouldn't need land title insurance actually when you're buying actually. Or you're transacting and purchasing a new dwelling, or even just land in itself. So it comes down to setting up the overall structures to ensure that when you're tokenizing that asset, that, A, do you own that asset? B, right? And what's the insurance policy on that asset when you're going to then tokenize it, right? Right now, because let's choose real estate as an example, because real estate's not operating on a blockchain and land transfer or the land registry is not, then we have to create these elaborate structures called special purpose vehicles that we put the asset into that then needs to be tokenized because of that. Had the land transfer or the land registry been operating on a blockchain, and I can just point to it, well, we can wipe out the SPV altogether, right? It doesn't need to exist anymore. So when you start,
interestingly, it's almost like the process of Polymath tokenizing an asset enshrines it in a way where, so long as that information that went into the process was accurate, to your point, you now have a way to prove ownership, to move and to transact in an asset. And that record will live forever, right? So it's like you embedded in the technology is the solution to the problem that you're describing.
Correct. That's right. Exactly.
Right. Yeah.
Right. It's all programmed in via smart contracts. We embed all that intelligence directly into the token itself. So
what are some of the projects that you're working on that you're most excited about, Vince?
A lot of real estate. I'd say a lot of real estate. And the reason why I'm excited about real estate is it's because it's been highly illiquid and not tradable in this way. You can be a fractional owner of something, of a limited partnership in a commercial real estate building or, a condo development. But typically, again, those are elaborate structures. Those are typically, through a network of people that are known. But, let's call this democratizing investing, in real estate, where you can become a fractional owner of something that can then be traded, very easily in the future. And you're not obligated then to pay land transfer and land transfer fees, legal fees in order to close that. Because, again, when you're purchasing a condo, you're somewhat obligated now to, close on that condo. You need to pay your land transfer tax. That title needs to change. When you're owning a fractional unit of real estate, all that goes away, right? And so you're investing directly into the asset itself, and there's greater security in owning that asset versus, let's say, a REIT, because a REIT is a structure that can technically be bankrupt actually via its management overhead, but the underlying assets are still whole, whereas investing directly into the security token itself, which holds that fractional ownership of title, actually you've got greater security against that.
Yeah. I feel like there's so many different explanations for why this is a good idea. I mean, what you're describing is access. So there's an asset class that investors can't otherwise get access to. This is a simple, efficient way for them to become fractional owners and then to have a way to prove that they own that and do transactions in those assets, right?
That's right.
And then there's the second component, which is just building resilient digital registries for assets that are not controlled by any single company or government, agency. And that's where the land title issue is probably the most extreme example, titles in Kenya or something, or in Honduras, which is where Hernando de Soto did a lot of his own research. But there are all sorts of other examples where we could use tokenization as a way to create open, transparent registries of assets, kind of like what DTCC does for transactions and securities, but on an open public network, similar to the internet, right? Like we already have this network that is a repository of information. It's public, it's open. Big parts of it are controlled and owned by big companies, obviously, but the underlying technology stack is open. And we haven't had that for assets, which is why I've always described blockchains not as cryptocurrency, though that's an important use case, but simply as a new internet of value or an internet of assets. And I feel like what Polymath is doing is related to that. So just to pivot towards the technology itself. So Polymath I described as a company, it's a fintech company, but you guys also launched a blockchain, did you not? Like the technology, like let's talk about because we have people who care about the tech side of this too. Is this on Ethereum? Is it on Solana? Are you building it on your own blockchain? Like talk about the actual underlying technology for us.
Yeah, so we started that like rewinding the clock 2017, 2018 when Polymath was created. It was building an application on to issue and mint tokens on Ethereum.
Yeah.
In late 2018, 2019, we made the decision to build our own layer one, right? And that was because what we found was there was difficulties with issuing and minting security tokens. We standardized the ERC 1400 for the industry on Ethereum. But there was, there are certain things that I guess were fundamental drawbacks on building a let's call it the trusted network of security tokens and actors on a chain. We felt that the industry needed a purpose-built chain for security tokens, full stop, right? And that meant like from being able to it's a public permission chain. And permissioned even from when I issue a security token that I have your wallet address, Alex, and I can send it to you, but you've also got the ability then to reject accepting that because maybe for some reason I had your wallet address wrong, or there's another Alex Tapscott actually on the chain as well. And so I can recall that transaction. You could reject it as well. On Ethereum, those are fundamental things you cannot do on Ethereum. I need your wallet address on Ethereum. I can send you something. You can't reject it. It's now inside your wallet, which is an issue in the securities industry now because I opened myself up to audit risk that somebody, maybe El Chapo, actually sent me funds or something of that nature into my wallet. Now I've got an issue. So we built a public permissioned blockchain for security token issuances for real world assets, full stop. All node operators and validators are financial services companies. They have to hold title actually that they're reporting up to a regulator, a financial services regulator. If they are, so think about a bank, a broker dealer, an exchange. Those are all examples of validators on the network. So they secure the network. We have over 100 node operators now globally. It's truly decentralized, and they're all financial services companies in their own right. The moment that they lose their license, they are removed from a governance point of view, from the ability to operate on the chain. Because we want to build that level of trust that's required for this industry in order to trust the network. Because if you don't have trust in the network, then you don't have anything. And that also comes down to then when we bring on issuers and then investors, everybody has to go through a KYC process. You have to be known, right, in order to get a DID to operate on the network.
Yeah. So that's something that I think is interesting and worth just sort of understanding at a deeper level. Like if there's Ethereum in these public networks, but you're saying because they're permissionless, that you can, like, transactions can occur between parties that are not compliant with the law of the land where those firms might be operating. And I think it's sort of interesting because, if another company that's operating lawfully is working on a network where someone else is not, then, that creates some issues. Now, I want to just understand that a bit better because my understanding is that BlackRock's Biddle fund is deployed on different blockchains,
Mm-hmm.
but primarily the Ethereum mainnet. Do you know how they're thinking about it? Like, how are some of these, and a lot of big asset managers, and financial firms are definitely using other public networks, I guess,
Mm-hmm.
even if it's just early stage. So, what are they wrong to do that? Do you think, or do they see things differently?
No, I think BlackRock, like I think it's a great proof of concept, right? And it was a pilot actually as far as with their money market fund. Now it was a lot of money that was tokenized, but it was orchestrated by the digital custodians that are holding it, right? So there are, I don't know how many digital custodians were involved, but there are 13 holders of that BIDL fund, right? It's
Yeah,
not widely distributed. It's not democratized. But it's a proof of concept that it works. It can be done, and who are the valuable stakeholders that are required in such an ecosystem? If you're going to offer that out now to, let's say, a wider audience, like just in a general marketplace, and I want to participate now in that BIDL fund, I think it would look very different, and there would be different players that would be there, and there would probably be a different set of processes that would be introduced as well. And so that's why we felt that a fit for purpose chain needs to be introduced, and maybe again that's what BlackRock will be heading down that path as far as, okay, we did this on these chains here, these are our findings, and this is actually how we need to operate going forward. And I think some of that activity is happening right now as far as, if I was to do this again, how would I do it differently? Our approach again is just to build something that broker dealers can license very easily. It can be integrated into exchanges going futures, whether it be a regulated ATX or to a DEX that's operating actually in the wild, right?
yeah,
We did build this on parity and substrate. It is not EVM compatible, but it will be EVM compatible by the end of this year, because I think that Parity and Substrate have realized that, by creating this closed garden approach, with their chain not being Ethereum compatible, has not been helpful actually to the overall industry adoption. Even though we've seen adoption, with our clients and our customers, and like I said, a lot of what we're seeing is, at least in the initial traction of what is being deployed on chain, a lot of real estate, right? What's lined up afterwards, ESG type of carbon credits, a lot of commodities and equities. We're launching a freemium product at Polymath early next week, which just to grab market adoption, because I think what we started to see, and it's what I saw in the early days of mobile money, it turns into a land grab, right? Those that can grab, as many different clients and customers in order to utilize the platform, those will be the winners overall. And I did that in my last company, where it was just sign up as many as you can, get all your clients in the queue. They all convert actually over to, paid customers and long tenured customers. We're doing the same thing here at Polymath. So we're launching a freemium platform, allowing, a company to launch, an initial investor portal, one company, one security token offering, one experience, right? If you like what you see, then convert that over into a paid enterprise product. But, we think that the experience is going to be, above and beyond what people are expecting.
Yeah, interesting. Well, Vince, one more question for you, which is, what's next for Polymath? What do you guys have cooking right now that people should be on the lookout for?
Well, we've launched an intention to go public, and we did that in early March.
Yeah.
The target date to be fully listed is August timeframe. Between the signing and go public, we've also decided to acquire an entity as well. I can't disclose that on this call, but stay tuned actually and follow Polymath actually for a lot of interesting news announcements. We will be acquiring a interesting company just to add more value to the public vehicle going forward. And that'll allow, again, investors optionality when investing in a Polymath company going forward. Once we're public as well, we've got other interesting companies that we want to be part of the Polymath story going forward. Anything, and what fits into our thesis is that anything that adds value to the layer one that we built that can unlock and help monetize value at the chain level is what's interesting to Polymath, right? So fund management platforms, ATS software, things that operate in the capital market stack, right?
Yeah, I mean, it sounds like you sort of view yourselves as being this vertically integrated solution where there's the technology, there's the company that does the implementation, but below that, there's all these ways in which you can integrate into the financial system, right, to make it all very seamless. And it almost feels like you have to kind of put all those pieces in place before it can all run incredibly smoothly. So it seems like a really good vision.
Yeah, no, I'm excited actually for what the future has to hold, and I'd like to see even like governments adopt actually this approach if they're selling off crown assets in the future, so that they can provide maybe you and I, Alex, the ability to invest in before selling it off to a private equity firm. Why not sell off that that next toll road, the 407, to people that live in the city of Toronto, right? Like why not tokenize actually the 407? You'd be more than happy to actually take that every day because you're going to get extra yield on that every month.
Yeah, absolutely. Vince, such an interesting conversation. Thank you so much for joining us. If for people who want to learn more about what you guys are up to, where can they go?
Go to polymath.network and sign up for our freemium. All the data is there, or send us an email.
Awesome. Well, that's it for this week's episode of DeFi Decoded. I'm Alex Tapscott. Excuse me. Forgot my own name. Thanks to Vince for joining us today. We'll be back next week with another great episode. Until then, have a great weekend, and we will talk to you later. Bye.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.